There are some early signs and signals that the Fed's plan might be working to combat record high inflation and other recession risks by way of the job market. Now, joining us to explain is the editor at ticker.co. That is our friend Sam Rowe. Sam, good morning. It's good to see you. So the job market is sort of the vehicle here, or one of the vehicles by which the Fed can slow growth and thereby slow inflation. Where are you looking in there to see if there might be some signs of that it's working?
So one of the metrics that Jerome Powell has been pointing to is job openings in the U.S. labor market, and specifically how job openings have been far outpacing the number of unemployed workers in the U.S. economy. And so one of the things that he's mentioned is that because of this disconnect, it's basically been giving a whole lot of leverage for workers to be asking for more money. And it's also put pressure on a lot of employers to increase pay in order to get those people into those job openings. So one of the efforts when it comes to tightening monetary policy is to try to get those job openings down in an effort to relieve some of that wage pressure, which in turn has been feeding into inflation. And so the official job openings data actually comes on about a 2-month lag. The latest stat we have, is from February, and we're not going to get the official March job openings data until early May. However, the job listing site Indeed regularly publishes their own job openings metrics, and they cover a whole bunch of different industries, so they give you a relatively decent proxy for what to expect with job openings. And through April, I believe it was either April 15th or April 16th, mid-April, they've noticed that the number of job openings have actually been coming down for a couple of weeks. So that may be a sign that whether it has anything to do with tighter monetary policy, what Jerome Powell is looking for in the labor market may already be beginning to happen.
Sam, is Jerome Powell, do you think he is setting the table for a sharp job market slowdown later this year, or is it, things just gradually cool off?
I think there's some nuance to exactly what that question is and what they're looking for, right? It could be the case that, there continues to be job creation, month after month after month. What he's looking for is to cool the labor market in terms of just the excess amount of demand that exists on the employer side. So, if we have, I'm just throwing out a random hypothetical number here. If we continue to have 300,000 jobs created month after month for the rest of the year, it could be possible that occurs under conditions where there isn't a whole lot of inflation pressure if the supply and demand in the labor market is a little bit more even. Because there's so much demand for labor right now, because there is so many job openings, you think of it from the perspective of the prospective employee, right? Like, let's say, for instance, I'm applying for a job. Well, if I have 3 different companies telling me that they want to hire me, then suddenly I can get into this sort of bidding war in terms of pitting all these employers against each other so I can get higher pay. But if I'm applying to one job and I'm just having this unilateral conversation with them in terms of pay, I don't have a whole lot of leverage. So maybe that is what comes into play when those wage negotiations happen. I might still get a job, but there may be less pressure in terms of wages during those sort of interactions.
What's interesting about all of this is, you have all of these high estimates for how much the Fed is going to raise rates at each meeting and overall. And I wonder if we continue to see the sort of number of job openings back off a little bit, what that does to that scenario. I guess if at the same time you still have hot inflation, it doesn't change the Fed's trajectory.
Yeah, so the Fed is really trying to thread a needle that is sort of really tough to wrap your head around, because as long as you have these excess job openings, it seems to be the case that there's going to be a lot of pressure in terms of inflation. But the Fed also wants to stop short of cutting so deep all the way to the bone that you suddenly get to the point where there's so many jobs taken off of the market that you begin to cut into the labor force and companies start laying off employees. So who knows exactly how that unfolds? It's basically like trying to, the way I see it, it's kind of like trying to land an aircraft on an aircraft carrier. Maybe it's possible, but it's just a lot more complicated and a lot more precision required than sort of what happens in a normal economy.
All right, and Sam, just want to mention also, we just got the PMI numbers from S&P Global, and it's some interesting stuff that we're seeing in these numbers, because on the one hand, manufacturing is a little hotter than estimated, 59.7 here versus the 58 that was estimated. Services, though, weaker than estimated, 54.7 versus the 58 that was estimated. So that means the composite is lower than estimated, 55.1 versus the 57.9 that was estimated. So overall, seeing manufacturing hotter and services weaker is really interesting, because we've been waiting for that shift. All of that said, above 50s expansion. So all of this is still expanding, and these are the April preliminary numbers, so we could see revisions. But there is a measure of price that's in here. And that price, that measure went to a record for both manufacturing and service providers. So again here, that sort of speaks to what you're talking about, that price is still going to be an issue going forward for us and for the Fed.
Right. Yeah. And to PMI, and you just mentioned that, because it's above 50, you still have growth in both the services sector and the manufacturing sector. So maybe what the Fed is trying to look for is a number that probably comes closer to that sort of 50 level, where you're still growing, but not quite as hot. Not so hot that it's forcing prices to continue to increase. Now, something that we're not really talking about is what happens with supply chains. I'm sure, I haven't looked at the report yet, but I'm sure if you look at the report, they're going to continue to have manufacturers and companies complaining about supply chain issues, which is forcing prices to continue going up. There could be some sort of miracle that happens some point in this year where supply chains loosen up, and it's no longer about having to cut the job openings, but maybe a lot of those job openings that we were talking about suddenly get filled. And that really is sort of at the core of what's going on in terms of inflation, right? It's not, the real problem is we have all this demand, which is a great high quality problem, but the supply chain is just not able to keep up. So maybe there is a scenario where everything continues to grow in such a way that has been causing all this inflation, but perhaps supply chains do eventually loosen up, and we do get some relief in prices.
Well, as long as my local supermarket, Sam,